IDF needs to
IDF give the receipt to you,
then they're good.
and you can claim that as a tax deduction.
Yeah.
Okay.
But up to 250, they don't need to get a receipt. They can still claim it
Yeah.
if they donate it to IDF
Okay.
or other 501c.
Now, for people who like to give a lot of money, there is a limitation based on adjusted gross income. Most of us can't afford to give this amount of money away, but some very rich people do. And charitable contributions to public charities and certain other organizations used to be capped out at 50% of AGI. Now, you could give more than that, but only 50% of AGI would be considered deductible, right? Now that's been increased to 60%. So, you know, if some of you want to solicit donations from Warren Buffett, you say, hey, you can give more now, thanks to Trump. No. Oh yeah, now this is the one that I call the Aggie Exemption. Deductions are no longer allowed for donations to colleges or universities in exchange for the right to purchase tickets or seating at athletic events. It used to be that, you know, Aggies would donate a lot of money to A&M, and then they'd be able to buy prime seats at the football games and all of that, and they'd claim a tax deduction on that. Can't do that anymore. That's been eliminated.
Is it kind of like because usually for charitable contributions, if there's a benefit, you know, it's in excess of the benefit, is that still there? Or is it the whole donation is no longer exempt?
It's no longer exempt.
So like if I get 50 grand, but the tickets are worth 2,000, my 50 grand is not.
Well, it's not the tickets that you're purchasing.
Yeah.
Your donation gives you the right to purchase tickets.
And so since you get the right, the entire donation is no longer exempt.
Correct.
Okay. Oh, okay. So,
Yeah.
gotcha. So,
Don't do that. Don't do that. Stop
Okay.
doing that.
well, they're not getting my money.
I don't understand charitable contribution of up to 60%. Would you elaborate more?
Sure. Let's say for example, my adjusted gross income is $100,000, and I live very cheap. And you can ask my wife, I do. I live very cheap. I live very cheap. But I'm also very generous. And I want to give my church $60,000.
Oh, okay.
Well, before, only $50,000 would be deductible. But now, those $60,000 would be deductible. Okay.
You can still give 80%, but only 60%.
Exactly.
A lot.
Yeah. You can give it all you want. Okay? So, casualty and theft losses. Now this one is also really important. It used to be that if you suffered a loss of some kind, let's say a car accident, and let's say for example you have a really expensive car, like I don't know, pick an expensive car, Tesla or Rolls Royce or something, and some you know lawn maintenance guy runs into it with his truck and does all kinds of damage to it. Well, you could claim your losses on that, because if you own a Rolls Royce, you're probably self-insured, right? So you're not getting any insurance payments. So you could claim a certain amount of that loss against your income. You could deduct it, right? Let's put it into more relatable terms. Let's say, you know, during a hurricane or a storm, you get some flood damage, and your flood damage isn't covered by your insurance because you don't have flood insurance. Okay, so you could get an estimate of what the damages were out of pocket to put everything back the way it was. You could take that amount of money and deduct it from your income, subject to 10% of AGI and a $100 deductible. So let's say for example, your AGI is 100,000. 10% of AGI is 10,000. So your loss would have to be more than 10,000 for it to be deductible, right? Okay. Still, in some cases, especially when you look at the areas along Tornado Alley, you know, Kansas, Oklahoma, Missouri, all of those areas where tornadoes do terrible, terrible damage. Sometimes their out-of-pocket expenses are just astronomical. Well, they could claim a loss if they weren't insured, or if the insurance didn't cover it, up to this amount. Well, now you can't do it. That loss is disallowed unless it is a presidentially declared disaster. So like Hurricane Harvey was a presidentially declared disaster. Hurricane Irma, Hurricane Maria, the California wildfires. All of those are presidentially declared disasters. So any losses in those areas can be claimed subject to these rules as a deduction on income tax. But if it's not presidentially declared, no.
But if the loss is less than 10,000, you cannot claim?
Correct.
He's been declaring a lot of disaster.
Well, 10,000, that's assuming 100,000.
Yeah. 10% AGI, okay. So it has to be a big loss.
10%.
And actually, at least for Hurricane Harvey, that 10% of AGI was removed.
Oh.
So I did
Anything.
several losses for people, and it's amazing how much they were able to get back.
What's the proof? Do we have to submit a receipt?
Yeah, this is really cool. For Hurricane Harvey, Congress allowed what they called safe harbor methods, because they knew that the records that people kept of the value of their furnishings and everything were destroyed in the flood. So they allowed a safe harbor method. And so all you have to show is that your property was flooded. Well, it depends on what area. There's different parts of town that have different rules applied to it. But for the area that I was talking about around Katy, if you had 3 feet of standing water in any room, then that area, that room, was considered a loss. And you could take that square footage of that area and apply a factor to it, and then you were allowed to claim that loss without showing any proof of anything. That's called a safe harbor methods, or methods where you don't have to show any proof. And so for Hurricane Harvey, they also relieved the 10% of AGI limit. So like, for example, I had one client, and this is somebody who earned good money, he's an engineer. He had a flood in his house. He did not have flood insurance because, of course, the real estate agent told him, you don't need flood insurance, you're protected by a levee. So he was flooded, did tremendous damage to his house. Brand new house, they just moved into it in July, and Hurricane Harvey was in August. The value of the property was almost $400,000. It was in Riverstone. And anyway, we were able to completely wipe out his tax liability. In other words, all of his withholding was returned to him for that year. Plus, we were able to carry forward to the next year. Now, we could have carried it back and gotten him a refund for 2016, but he chose to carry it forward. That was his choice. But that's pretty substantial. Now, does the tax break take care of all the damage? No, of course not. But it sure helps. You know. So if any, and by the way, if any of you did suffer loss in Hurricane Harvey, it's not too late to file an amended return. So, miscellaneous itemized deductions. This is where some of you may not be happy. Effective in 2018, the law repeals the deduction of the following expenses, which are subject to the 2% AGI limitation. These are miscellaneous itemized deductions. One of those, investment expenses, So let's say, for example, you have an investment account at Schwab, and you're paying money market or money manager fees. They used to be deductible, not anymore. Tough luck. You used to be, if you were a day trader, and you had a margin account, your margin interest was deductible. No more. Tax prep fees, fees you pay me, no more.
Taken away.
That's okay, my fees are cheap. Now here's the biggie, unreimbursed employee business expenses. You work for an employer that says, like, I used to work for Fluor. Now, if Fluor sent me out on location, they would pay my mileage. So I had a project where I had to go out to Seabrook just about every day. And they reimbursed me for my mileage. But some employers won't reimburse you for mileage. You gotta pay for it yourself. For those people, they could get this tax break, unreimbursed employee business expenses. It's a business expense that doesn't get reimbursed. Well, now that's gone. So some of the things typically that engineers, things that I have been claiming before, things like association dues, gone. Professional magazines, books, subscriptions, gone. Meals while I'm on site, gone. None of that's deductible anymore. Okay? And that, I believe this expires in 2026. So. Okay, here is good news. If you make a lot of money and your itemized deductions are really big. It used to be that your itemized deductions were limited. Once you had a certain amount of taxable income, then your itemized deductions would be phased out and disallowed. Okay? That has been suspended. Now your itemized deductions are unlimited. There's no phase out. The phase out is gone. At least until 2025. Okay, so once again, looking at this, with the changes in the tax code, you can see limitations have always been here. So that's kind of hard to meet. This limitations have been imposed. All you're going to be able to take is 10,000 max. Interest you pay on your primary residence is limited. So it's real easy to see that you might have trouble getting to that $24,000 standard deduction.
The tax you pay, the sales tax, if you buy a lot of things every year, that's good at 24.80.
That's limited.
Was it limited?
Yeah, state, local, and sales is limited to 10,000, and that includes property tax. So yeah. So all of that in that section for taxes you pay, which includes property tax, state income tax, sales tax, all of that, is limited to $10,000
For 2018.
for 2018.
Okay.
So, chances are the standard deduction is going to be applied to most people unless they're generous givers and have a lot of charity contributions. Because casualty and theft losses are gone, this is gone, just about everything is gone. So,
So unless you have a big medical expense or you gave a lot to charity, then you should just
yeah,
standard.
right, exactly. AMT, I won't go into a big discussion on this, but let me just tell you a little bit what AMT is, alternative minimum tax. Back in the 1970s, you might have noticed, if some of you have followed American politics, there's one particular political party that always says, oh, those darn rich are never paying their fair share, right? There's one party that always says that, right? Well, back in the 70s, they were really hammering it hard, and they got a lot of support from the people. And there was this feeling that there were so many tax breaks given to the rich, and that the rich, whoever they are, just weren't paying their fair share. So Congress, in their infinite wisdom, decided, well, we're going to fix those guys. We're going to call something the alternative minimum tax, and you're going to pay at least that amount, no matter what. problem is, this alternative minimum tax, the threshold, the threshold had been at this $54,300 ever since the 1970s. It's never gone up. Now, if you made $54,300 in the 70s, you're doing really good. Believe me, you're doing really good. If you're making that much now, you're not doing so great. But if you're making that much now, we're in 2017, you would have been subject to alternative minimum tax. Well, fortunately, in the last Congress, they decided, gee, that seems really unfair. Let's increase the exemption. So they kicked it up to $70,000 now. For married filing joint, it's gone up to $109,000. But look at this exemption phase-out period. Here the phase-out, the exemption phase-out. Now, what is the exemption phase-out? The exemption is if you make money below that, you don't get hit with the AMT. If you make money above that, that's fine until you hit $120,700. When you hit that, then that exemption starts to phase out, and your AMT applies all the way down to 0. Right? I know it sounds a little complicated, but take my word for it. By increasing the exemption phase-out, look at how much that exemption phase-out has changed. From 120 to 500,000. Chances are, if you've been hit with AMT in the last couple of years, you're not going to get hit this year. So, now, for those of you who use TurboTax and all that, if you're like me, like I used to be, I used to like to play around and say, well, hey, what if I increase this deduction by this? How much would my taxes be lowered? Or how much would my refund increase? You know, I play around like that. And sometimes you would increase the deduction and increase it, and the tax just stays the same. And you say, why? Well, if you look under the hood, you'll realize that it's because of AMT. That's why things aren't going up. I know. That's why. So now AMT is exempt, the phase out has gone up, and anyway, that's what all that is. Here's the child tax credit. Here's what y'all been waiting for. Here's the good news. $2,000 credit per child, and the phase out doesn't begin until $400,000. The way it is right now, I think the phase out starts at, well, in 2017, like 120.
Yeah, very low.
Okay, so now it's 400,000. Here's the other good news. Let's say, okay, this just applies until the year in which your child reaches age 17. When your child reaches age 17, you don't get that credit anymore. Okay? Well, they've added something. Now you've got a kid that's 18 years old, you sent him off to college, now but he's still your dependent, you still get a $500 credit. So you're still getting a $500 credit, no matter what. And out of this, $1,400 out of that $2,000 is refundable. So like if you're in a low income group, that's good news. That means that you get a big refund.
And this is credit.
It's a tax credit.
It's a tax credit. It is a credit,
Yeah,
not a deduction. It's a credit. So that's good news.
that's 3,000.
Yeah. And finally, the Obamacare penalty effective this year is 0. Now, one of the topics on my agenda was business entities. You want me to go through with this? Or are you getting that
next
tired?
time? Unless you have,
Business.
This-
But we have a second session next.
Yeah, maybe, yes.
I'm sorry.
I know it's
This
taking a lot.
is short, but it would still take probably half an hour.
Right.
So if you want me to, I will. If not, it's okay.
Is this like LLC or something like that? Right?
Yeah. Let me just describe one little thing. An LLC is a state entity. It is not recognized by the IRS. So if you form an LLC in the state of Texas, what that does is it now obligates you to pay Texas business tax, what they call franchise tax. And you have to file a return in Texas. So if you just keep things simple and don't file an LLC, and use your business, you file your business return on the 1040, then there's no Texas franchise tax. You don't have to worry about that.
But the
Keeps things
CPA
simple.
The CPA will generally schedule K1 anyway, right? Should be okay.
That's not a K1. It's, the K1 is not for an LLC. An LLC can take three different flavors for the IRS. It can either be a sole proprietorship, in which case there's no K1. Or it could be a partnership, when there is a K1. Or it can be an S corp, which is also a K1. But that's what's described here. What I'm saying is, why do you want to form an LLC? What's the purpose? Liability protection. Protection of your business assets from your personal assets. Okay? That's the only reason. If you have a small business with very limited business assets, why do you want to do that? Now, I've heard of all kinds of CPAs telling people, yeah, form an LLC. That's because they're making money off of it. Don't do it. Come talk to me. I'll be honest with you.
That's
Don't
not
do
what
it.
he said.
So,
That's not.
okay, so, all right, so I'll talk to you then.
But okay, if your business gets bigger, let's say for example in oil and gas, you're into exploration, making lots
So
of
how
money.
much is small, how much is big? So let's say it is less than $500,000, is that considered big?
If it's,
So
well,
let's say
if it's,
around $400,000, is that considered big?
in revenue,
No, in the value of the asset,
of the value of your assets, of what, your business assets or personal assets?
the LLC asset.
The LLC assets. Well, your LLC assets are going to be subject to lawsuit anyway.
Yeah.
What you want to do is protect your personal assets. So, let's say for example, if you're a sole proprietor, and as a sole proprietor you have a little coffee shop, and you serve some homemade donuts, and one of your customers gets ptomaine poisoning from your donut, and they come back and sue you. Well, they can sue you for everything you're worth, including your house, and your car, and your 401k, and your, everything else. If you have an LLC and your donut shop or your coffee shop is under the LLC, they can just go after the business assets, theoretically. Theoretically. There are lawsuits where they have gone after assets of the officers of the LLC. So that's what makes me, I really wonder what the value of a sole member LLC is. I'll argue that with any CPA. I don't think it's worth the paper it's written on. I really don't.
You can take a personal lawsuit if you feel the individual is liable. So, if he's the owner of that coffee shop, and I felt like, well, he made the donut too, so I could bring a lawsuit personally on him. So the LLC didn't technically.
What about the other ones?
Okay, for a K1, for a partnership or a S corp, it's probably a good idea to form the LLC.
Okay.
And that's, but again, a lot depends on size. Why would you form an S corp? I've seen little bitty companies operating out of their home, making less than $10,000 a year, that call themselves an S corp. Why? You go to a CPA, and correct me if I'm wrong, but most CPAs are going to charge you at least $500 to do an S corp tax return. And it goes up from there. I mean, that's like for the little mom and pop shop, okay? Same with a partnership. They'll be around $450 to $500. Why do that if you're that small? It makes no sense to me. But if your revenues start getting big and your liabilities in terms of employees and assets start becoming big, it's probably a good idea to incorporate under state law, which would be the LLC. And once you do that, the state tells the IRS, hey, this guy formed an LLC, and unless you do something, they're going to expect a partnership return or an S corp return from you, which means more money. There's just a lot of paperwork. And so if you get into this without advice, you're going to end up costing yourself a lot of money. So I advise you to get good advice.
before you charge separately for personal and LLC? Yeah, I'm just kidding.
Well, let's say, for example, let's say that you're self-employed, and, but you don't have an LLC. Then you get charged the same as any other 1040. You know, with a little bit more because of your
The
business.
pass-through tax.
Yeah, oh, and that's the other advantage now for, this is the last thing I promise, that I wanted to tell you today, is the, I don't know if I have the slide on here, but I'll tell you real quick. There is a 20% deduction on qualified business income for all pass-through entities. And that includes self-employed. That includes sole proprietor. What does that mean? That means, let's say that you have an S corp. Let's keep it simple. You have an S corp. As the S corp major shareholder, you're paying yourself, you're the worker, you're paying yourself a salary of $50,000 a year. Okay? So $50,000 a year, you subtract that from your profits. The S corp ends up making $100,000 in profit. Subtract 20% of that. It's taxable income. That's basically the way it works out. It's a little more complicated than that, but that's basically the way it works out. If you're a sole proprietor and you work out a Schedule C, your business makes a profit of $50,000. Take $10,000 off. Qualified business income deduction. That's new this year.
So that's like a safe harbor, you don't need to prove anything? You get
Well,
20% off.
you're proving it by showing your revenues and your expenses.
No, but I mean, the additional 20% off that, you get that.
The 20%, let's say you report, we'll keep it simple. Let's say you're doing a Schedule C, and you're reporting a profit of 50,000. That 50,000 then goes on 1040, whatever line it is now, they've messed it all up. Put it there. Then before you calculate taxable income, you get to take 20% of that off. You subtract, so let's say that 50,000 gets added in with all your other income, you get to take 20% of that 50,000 off. Deducted.
Oh, it's kind of like the standard deduction for the business.
Exactly, it comes off in the same place
Okay.
on the forms. It comes off in the same place before tax is calculated. So that 20% comes off, and that's brand new.
So that goes off on the Schedule C or when it goes to the 1040?
It's on the 1040.
On the 1040.
On the 1040, right where you have your tax calc, just before you do the tax calc, you have this.
So after the ADR.
Exactly. And after taking off standard deduction, when you take this off. It's called QBI, Qualified Business Income. Okay? So that's the only thing that's really new for this year. Also, the only other thing I have to say about businesses is keep your receipts. Don't be sloppy. If you're in business for yourself, you got to realize you're doing everything that your employer used to do. So when you make purchases, here's the way the IRS does in an audit. I'll tell you right now. You come before an IRS auditor and he wants to see receipts. You say, I have no receipts. It's all disallowed. He will disallow every deduction without a receipt. And he's not going to give you a second chance to come back. And the receipts and the documentation have to be what they call contemporaneous. It has to be from the time the expense was made. So like I have clients every year that says, oh gosh, I can subtract mileage. Let me go back and remake a mileage spreadsheet. Well guys, it might fly past an auditor, but I'm telling you right now, you're breaking the law because that's not contemporaneous. Now these neat little apps on your iPhone, they help you keep things contemporaneous because they got a date and miles and everything on it. So if you're in business and you're going to business meetings all over the place, keep track of that. Those apps are worth their weight in gold.
Those things, you can download a spreadsheet at the end of the year.
Yeah. So, but anything else, keep receipts. Also, entertainment expense is something that has been done away with. You can no longer now, ladies, close your ears. Guys, you can no longer take your clients out to the strip clubs. No longer deductible. Well, I guess you can, but it's just anyway. So meals, business meals are deductible still, like they always have been. But entertainment, you take a client out to an athletic event or anything else. It used to be that if it was some kind of way connected with your business, you could deduct it. Anymore, you can't. It's been disallowed. So So it's gone. But that's it, that's all I got, I'm sorry, I went over so long. If, the reason I gave you these handouts was to give you a really long but complete summary of the Tax Cuts and Jobs Act in different areas, and if you have any questions, feel free to contact me. I have my cards right here, you can take one of my business cards. I also have here's my business information. Thank you.
Thank you again, Jim. Very informative, and we have little token of appreciation for you.
Thank you very much.
Mas Judy mau itu.
The one behind it, you don't. So, thank you very much, Jim.
Thank you for having me.
Appreciate it.
Mas, ini gantian dah. Mas yang itu loh. Ini foto dia.
Also, if you guys do your taxes on tax software, and if you have any questions, I'm also available for consultation on that. And
I would like to take a picture you and
Sure. Thank you so much. And for all your help doing the CS taxes for 3 years.
Okay.
Thank you so much.
Thank you.
Oh ya, terima kasih.
Kemudian kita foto bersama. Let's take a group photo.